So in the same way that DeepSeek model scared a bunch of people, said, oh no, China's beating us in AI. The reality was a rising tide lifts all ships in this market, like, because every other AI shop is going to say, oh man, that multi-headed latency approach is really brilliant.
Yeah.
Because it saves a ton of memory. Let's implement that in our models.
But training is not going away. These models have to be retrained on all the new data that's created on new modalities.
Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
We might as well get an on-time start. Not too much to add from last Wednesday on Exhibit C. We do have Russian production curtailed here by about 600,000 barrels and Iranian production curtailed by around 800,000. When we sent 3 people to Saudi Arabia to meet with 3 Russians, the reports on that meeting were positive, but the report was they're more interested in getting sanctions lifted than they were in arranging a deal with the Ukraine. So if the Ukraine deal happens, sanctions will be lifted, and this curtailment of 600,000 barrels in Russia will go away. On the other hand, Scott Bessent, the Treasury Secretary, who's in charge of sanctions in the oil market, and mostly by policing tankers and payments, was quoted as saying they'd get Iranian exports down to only 100,000 barrels. Last year, they exported 1.5 million barrels, and they plan to export this year 2 million barrels. So this only has Iran curtailed by 800,000 barrels. If there's peace or a cessation of hostilities, let's put it that way, with Ukraine and Russia, unless Iran decides to enter into negotiations to get their sanctions lifted, I think the oil price in the $70 range may be reasonably secure. You can see demand, which is a real question mark, is only up 1 million barrels a day, 25 versus 24, and that's with China flat. And not too much increase in the rest of Asia. So I think the oil price may be okay. Now, when we move to the price of gas, of course, it benefited enormously from the cold weather and from a resumption of growth in LNG exports. On Exhibit B, that LNG feed gas at 14.5 looks like it. The next time this gets revised, that'll go up because we're already at that level. The big problem here is supply. We're already at 105. So LNG exports going up and dry gas production going up may kind of offset each other. In terms of data center energy, we simply have gas used to make power going up by 1.5 Bs a day, which has been the pattern over the last 5 years. I think that's about right, despite all the publicity about data centers needing power. I think that is about the right number. In terms of the futures, oil is hanging in there in the 70s or high 60s. Gas is hanging in there above $4. That's a huge improvement. I mean, the price of gas last year was $2.40. But here's the problem. There is a problem with cessation of hostilities in Ukraine. Look at the average price was $3.70 in 21 and then $6.22. That's when Ukraine was invaded, and Germany and the rest of Europe had been running on Russian gas, which was curtailed. And the price of gas in the US went to $6. The price of LNG was, $25 or $30. And Europe learned to live without Russian gas. And, so in 23, we averaged $2.75, we averaged $2.40. Now with the cold weather, we're back so that 25 here estimate is 350 as compared to the strip at 440. The problem is that if there is a deal, the Germans will pretty quickly, and the rest of Europe will pretty quickly go back to using Russian gas. That will reduce the price of LNG into Europe, and that will be reflected in the US price. Just to do simple arithmetic, if the price of LNG into Europe now is $14, generally takes about $1 to transport it, so that's down to 13. It takes about $3 to turn it into LNG, that's down to 10. Obviously 10 versus 4, that's a healthy margin. I think if you start to get large amounts of Russian gas consumed in Europe again, I think that LNG price would probably adjust down to $8 or $9. Then you take $4 off and you're back to $4. You know, that's not going to be a positive for the price of gas in the US if that happens. Exhibit A, lots of publicity about the House passing a budget reconciliation bill. I haven't seen any real details on it, but the key, of course, is to try to get spending down below the $7 trillion that's predicted for this year. $7 trillion includes $1 trillion for interest. Can't do much about that. In fact, that will probably trend up a bit. Defense at $900 billion. I haven't seen anything in any of the news sources that indicates that we're going to spend less than $900 billion for defense. Clearly, in the all other, there should be some amount of savings. It's supposed to be $1.3 trillion. Before COVID, it was $900 billion. Certainly, some money should be saved there. Then what do? I mean, Social Security is about on, $1.6 trillion. That's pretty much automatic. I think where all the publicity is going to come from is the federal government trying to cut back Medicaid, which are payments made to states to run their Medicaid systems. I think that'll be a lot of publicity, but making a significant dent in that $7 trillion is a tall order. I think the DOGE effort is good. Certainly come up with some really ridiculous things like sending Social Security checks to people that their deaths were never recorded. But can they make significant dent on that $7 trillion? We'll see. Is there a capital markets problem if they don't? I do think so. I don't think, even though we're the world's reserve currency, we can $2 trillion deficit. So how could you make with tariffs? Not a couple $100 billion, I think would be about as much as you could reliably predict. Individual income tax, 2.6 trillion. Can you move that up some? Possibly. Corporate income tax is surprisingly low, only 500 billion. Can you move that up perhaps a little? Payroll taxes, which are, pretty regressive. I don't think you could do too much there. Mike, Jason, anything else to add on our macro situation on spending?
I don't know if it actually would move the needle, but the latest announcement out of the Trump White House is the Golden Visa program, which they've proposed as a way to generate money to offset or pay down some of the debt. So we'll have to watch that one unfold. I don't know if you saw it. Did either of you see the details of that? I believe it's $1 million or $5 million, and you would only be taxed on your income in the U.S.
I don't know whether wealthy people from overseas are going to be volunteering for getting taxed on their U.S. income. We'll see.
I guess one proposal I heard was maybe companies will buy these golden visas as a way to bring highly educated, qualified labor to the U.S. Circumvent the H-1B process, maybe.
Yeah. Starting from the back, page 20 and 19, we have some healthcare companies, and I don't know whether there's any healthcare news, but there is some healthcare macro stuff. Jason, any news before we get into the healthcare macro stuff?
Yeah, tangentially healthcare related. Celsius, the energy drink company, has announced the acquisition of Alani Nu. So that is, in my opinion, it was their biggest competitor because their product was so similarly aligned with Celsius. It is also a sugar-free, caffeinated, vitamin fortified drink. This one was marketed 100% towards women, where Celsius was a 50-50 split in their customer base. And then traditionally, energy drinks were largely marketed to men. So this was their competition. They were, Celsius was pulling in a lot of new female drinkers to the category. So they ended up paying about $1.6 billion for them, which I think is actually a pretty fair price. They're fast growing. They're doing about $600 million in annual sales and already profitable as well. So kind of a way to buy growth for the company. The other news is Lantheus reported their earnings this morning. We talked about it a couple of weeks ago. It seems like the market gets kind of pessimistic about Lantheus, with competition for prostate cancer therapies, but we keep going back to their bread and butter is the diagnostics. And then it seems like every quarter they release their numbers and everyone's like, yeah, okay, the diagnostics is a great business. That happened again today. So they're seeing a little bump in their share price today.
Right. Anything on pain medicine and Vertex pharmaceutical?
Nothing new there. They've been working on their commercialization efforts. So they're trying to get it make it available in their first category is hospitals. So they want it to be available to the big hospital networks first. They see that and they're probably right. And that's the biggest bang for their buck.
We're going to get into GPUs and NVIDIA for the last 5 or 10 minutes because NVIDIA is reporting after the close today. But in the meantime, we're going to talk macro health with Jason leading the way. And Mike's going to introduce this subject. But basically, the president signed an executive order yesterday or the day before on transparent pricing for hospitals. And Jason is the advocate for this happening. But Jason and Mike work all day together. Why don't we have Mike introduce the subject and then Jason will give us a definitive talk on what this means. So over to you, Mike.
Okay, so most of us on this call are consumers of healthcare in the American system. And I challenge any one of you next time you go to the doctor to ask them before they do the service how much it's going to cost. I regularly do that, mainly just to see what the reaction is, because it's almost always, So it's not something that our system is set up to do well. Healthcare pricing transparency is purposely obfuscated because the price one person pays is often very different than the price the next person pays. Trump passed an executive order signed an executive order during his first term that would require hospitals to have some level of price transparency. This was not enforced by the Biden administration. So this executive order is, I believe, just restating and maybe expanding the scope of that price transparency. And I believe the timeline is relatively short, about 90 days. So I'll turn it over to Jason because we've done quite a bit of work on this, mainly because we had a research position that was closed that is going to be certainly directly affected by it. But yeah, I'll turn it over to you, Jason. You can kind of give our view.
Right. So in Trump's first term, he did sign an executive order mandating price transparency. Of course, COVID happened, kind of stalled enforcement there. The Biden administration did not pick it up. So this executive order is really like giving teeth to that first one. So in it said you have 90 days to publish your pricing or enforcement will begin. The analogy I have in my head is going to a fast food restaurant and ordering a cheeseburger. And if you tell them you're going to pay cash, they'll bill you $4 after you eat the burger. If you tell them you're going to swipe a government-provided food stamp card, they're going to bill you $12. They're going to bill the government $12. And then if you've ordered that cheeseburger with an iPhone app and paid with an Amex you're going to pay $22. It's illegal in any other industry, and why we don't require that here is crazy. The hospital networks have fought this all the way to the Supreme Court, arguing that it's their First Amendment right to have negotiations not in public, and that was overruled. So they have to publish their pricing data. It's crazy that they don't. The cost of the system is huge just through the price gouging. The same service can vary by multiples, depending on the hospital you go to on either side of a street, essentially. So long overdue here. I hope they do enforce it.
Right. And consumers in general don't know or really care usually because their insurance is going to pay for it. But as the high deductible plans get more prominent, you're going to see more people shocked at how much they spend and wanting to price shop for services they need to consume. So this is as much an important thing from the perspective of having an efficient healthcare system as anything else.
Yeah, I think the expense of insurance has gotten so large that companies are now starting to shop that around. In the past, they haven't. It's often sold through brokers. The brokers did not disclose that they have side deals with some of the providers. That's changing. They'll be able to get transparent pricing through the plans. I think that's part of the executive order as well, is there has to be, the plan providers have to provide transparent pricing as well. And now businesses will be able to shop for the best insurance coverage. So that's, there's multiple layers of obfuscation, and you don't know how much that any service is going to cost you.
So with that in mind, what's the read through for impact on maybe healthcare stocks? And
well, yeah, the research position we had a company that operates outpatient clinics. So these surgical centers where you're going to go have a routine procedure done and you'll be discharged the same day. They also had a number of hospitals. So that's why we ended up closing the position is the risk to the hospital operators. So most hospitals are doing this practice where they hide the pricing. Ultimately, people will be able to price shop. So they'll all have to compete on price, and they'll go to the lowest cost in the area.
Yeah, and scale isn't necessarily inherent with size, right? So your cost to deliver service advantage is not necessarily related to the size of your operation. There are some instances, and we do have a position that does act like that, but
I think in hospitals it's not. You see large operators having a lot more administrative overhead, and that's going to drive their costs higher.
Right. Do you think, Jason, sitting here now, our discussion about the $7 trillion of spending, you think in time, maybe not this fiscal year, but next, there'd be some significant savings in the Medicare line or the Medicaid line?
Oh, yeah. I definitely think so. I think the government's own admission is, I forgot the exact number, but it was pretty huge of the amount of fraud that they know occurs every year. So if we can eliminate that, eliminate the overbilling, I believe the DOJ just launched an investigation into United Healthcare over that practice. And then there's been some conversations kind of across party lines, which is good. Mark Cuban and RFK Jr. talking about the problems that exist in Medicare Advantage and Part D and around reimbursement for prescription drugs, and how there's a lot of added expense in there. No surprise to me that Mark Cuban's biggest enemy is the PBMs. So I think there is a tremendous amount of savings to be had in our healthcare system.
All right. Good. Well, more on this in coming weeks. There is a podcast out with the CEO of Microsoft, and he makes a statement or a judgment in that podcast that large language models will not be winner take all, which is what Mike and Jason have been indicating in past Wednesdays. In other words, the fact that Grok 3 is better than Llama, better than the latest Gemini are better than the latest OpenAI, the different providers of large language models will just keep trying to improve them. And in the end, it won't be down to one or two. There'll be four or five or six, or at least that's a prediction. Jason, how do you see that? I mean, it requires so much GPU capacity and we see where Amazon and Microsoft and Google and Oracle are all predicting that they're going to invest more money in their CapEx. How do you see this? How do you see this a year from now, or 2 years from now, or 3 years from now? Will someone say uncle and start to pull back? Is the someone Microsoft, who there was some publicity this week that they had abandoned some leases and future data center sites, or what do you predict here, Jason?
Yeah, I think, Mike and I have been saying this for a while, that these language models will be commoditized. The data that you plug into the model is going to be what matters. So they're all going to be roughly equivalent, probably in the end, on their ability to certainly generate text, coherent sentences, and then thoughts around synthesizing the data that's underneath. So what really matters is what is that data underneath. And that's the proprietary value that any one player in the space will have. It won't be the model itself. And I mean, you see DeepSeek out of China and Meta are open sourcing their models with the weights. They're just giving these things away.
Right. And the reason that they're giving it away is because they have proprietary data. Well, I don't know about DeepSeek in particular, but Meta in particular doesn't care to give away the models because they care more about the models moving down the curve faster. So in the same way that DeepSeek model scared a bunch of people, said, oh no, China's beating us in AI. The reality was a rising tide lifts all ships in this market, because every other AI shop is going to say, oh man, that multi-headed latency approach is really brilliant.
Yeah.
Because it saves a ton of memory. Let's implement that in our models.
But training is not going away. These models have to be retrained on all the new data that's created on new modalities. So we're going to begin training on video and everything else. But if you look at cloud computing, a lot of the first instances of running servers in AWS was for development, and then the application still got deployed on premise, somewhere else. Just the developers didn't need to have servers in their office. But now the big business is applications are deployed in AWS for use, by everybody, right? Netflix is hosted at AWS. It's not hosted out of, a server in your basement. So the inference build is really the CapEx going forward that matters. So who's going to supply inference chips? And it'll be a variety of vendors, but NVIDIA is the only kind of agnostic one that matters.
Oh, since we're talking about that, you want to talk about PTX?
Yeah, so when DeepSeek came out, some of the negative reporting for NVIDIA was around people circumventing CUDA. The way they circumvented CUDA was to go to the layer below and optimize that software layer, which is called PTX. So it's kind of like the assembly code underneath the high-level programming language. I think that just further locks you in to NVIDIA's chips. So if you are building code just against CUDA, you can port that to AMD's version of that fairly easily. It's not full featured, but if you're investing the time and resources to go beneath CUDA and program to the underlying language, you're a lot more locked in at that point to using NVIDIA's GPUs. You can't just do an easy port at that point.
Right, and the data that we're seeing so far since DeepSeek version 3 was released is that orders for the chips eligible to be exported to China, the NVIDIA chips, are going through the roof. So I'm sure that we'll get a summary of this later this afternoon on the NVIDIA earnings call.
Yeah, I think the biggest point is DeepSeek was offline for a few weeks because they did not have any inferencing infrastructure built in China. Now we know they have to use NVIDIA chips because they've optimized on PTX, and they need to build an inferencing infrastructure, which was driving all the sales from NVIDIA for the last year, in the US at least. So I think they'll have a pretty good outlook, a pretty positive outlook for the coming year.
What about export controls imposed by the US on chips?
Well, Trump's signaled that he's, going to extend the chip export controls. But as we know with Trump, there's always a deal to be had. So I think we still need to wait and see. I haven't heard anything beyond that. Have you, Jason?
No, just threats, right? And it is a big risk, but the DeepSeek models are built for the chips that are allowed to be exported over there currently, which is not the most latest and greatest.
Right. Any sign of any competition, either Google designed chips or Amazon's designed chips or AMD or Intel or anyone closing the gap at all with NVIDIA?
Not the latter two, but certainly the hyperscalers are going to build their own chips one day. They already are. As their use cases get more solidified and the software is more mature and they know they're not changing their models, they'll design chips kind of specific to those models. But there's always going to be new use cases, and they'll need the flexibility. And the customers using their cloud products, renting server space, will most likely want a more generalized, flexible solution. But I think the market's going to be huge. I think every software product will have an AI component to it.
Oh, what do you say? When AI works, we call it software.
Yeah.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
Hi, everybody. I am not at Oak Cliff today. I'm actually in Daytona Beach, sneaking 2 days in between one stop and the Virginia stop on the tour, which is this Saturday. Ewan, our high school sailor, and Ethan, the training director, are in Pensacola racing and practicing and training at the foiling camp, which has turned out to be super cool. And back at Oak Cliff, they're getting closer and closer to launching all the boats. April 5th, we have an art show that we hope that you will come to. And that also brings up the point, if you did not get an email about the art show, if you did not get an email personally from me yesterday, it's time to go to oakcliffsailing.org and sign up for the newsletters. We want to keep you informed. We want to help you in your sailing career and your philanthropy. And I hope that you have the sun come out like we finally did here in Florida. Talk to you soon.
And now back to the show.
Any other things we normally cover where there's news? Tesla is not doing very well on their unit car sales in Germany.
Yeah, I saw an advertisement from a bus stop in Europe that basically was promoting Musk as being a Nazi. So he's not a popular figure over there right now. Certainly with his support of the far right party in Germany. However, that party did quite well in the German elections. So I think there is some signs of change happening over there, but it's not panning out well for European Tesla sales.
Maybe we'll get a good entry point, because they have announced a really kind of a big innovation around injection molded panels. That's going to dramatically reduce production costs. They're just layering on innovations, and it's going to be hard for other automakers to compete on price.
Yeah, right. We're rooting for $150 a share.
Right. As we said last week, we'll have the NVIDIA results to discuss next week. We're going to try to identify companies, and certainly NVIDIA, certainly Tesla, maybe Netflix, where there is enough going on that's really not impacted by how our economy's doing, not impacted by how our capital markets are doing, but where there's just a huge change taking place. NVIDIA, you could say the change has happened. If you've owned the stock right through here, now's the time to exit it. But if there continues to be use, what Mike and Jason have already said, if the hyperscalers buying all these GPUs can monetize them, this isn't necessarily anything like a peak for the revenues and cash flow and whatnot in NVIDIA. So the question is it cyclical? Is it going to get to a level that's not sustained? The same question on Tesla, autonomous driving, or just, they're being able to not exactly match BYD in cost, but to bring their cost way down. Is that a sustainable position? And then, what do you have to pay for it? If you had to make a prediction, Mike and Jason, the last couple of minutes, about where between NVIDIA and Tesla, 150, you're better off at Tesla at 150 or NVIDIA at 150. Which one would you pick between NVIDIA and Tesla?
Yeah, well, definitely Tesla at 150. Because again, the downside is relatively low in our minds as a scale manufacturer of automobiles, just pure automobile manufacturer. They're the only ones in the US that really build most everything in their cars. They're also the only real scale non-union automotive manufacturer. And that provides them with extreme levels of advantage because they can make changes to their production lines more frequently than once per week. I mean, that single factor.
Once per year, maybe.
Yeah. I mean, the hindrance to being great at manufacturing that occurs due to unions is and should not be understated. In general, you want a competitive workforce and you want things to be balanced between the employer and the employees. But if the union's causing the employer to be uncompetitive or not able to innovate, then you've got a real problem. So Tesla's got a clear advantage there. So I think that core business is great no matter what happens to the software side of the business or other potential competitors.
Well, there we have a way of keeping score. You're better off at Tesla at 150 or NVIDIA at 150. That will be our mantra. Yep. Listen, we run over. In the meantime, everyone be well and stay healthy. We'll be back here exactly 7 days from now. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.